I had a sales call recently with someone who just downloaded our tax planning checklist. They came in with one thing on their mind: how do I reduce my taxes this year? As we talked, I started to ask deeper questions. When do you want to retire? What does financial independence look like for you? What do you want money to actually do for your life? They did not have a clear answer to any of those. What they did have was a vivid memory of writing a big check last year from under withholding. Both of them had gotten promotions, income went up, and withholdings did not keep pace. So when tax time came up, it hurt. So now everything in their financial life was being filtered through one question: how do I make sure that never happens again? And here's the line from that conversation that I keep coming back to. They said explicitly that they would rather save on taxes this year than having more freedom and flexibility later. So I want to talk about that because I think it's one of the most common and expensive ways that smart people let a real but manageable problem take over their entire financial decision making. My name is Ethan Ho. I'm a certified financial planner and the founder of Cloud Capital Partners here in Hawaii. I help people stop making financial decisions based on anxiety and start making them based on clarity. If you want practical, honest financial planning content, hit subscribe. Let's get into it. Before anything else, I want to put the 24% tax bracket into context. If you are watching this in later years, the thresholds may have shifted, but the principles apply regardless. For 2026, the federal 24% bracket for single filers starts at $103,351 and goes up to $197,300. For married filing jointly, it runs from $206,700 up to about $394,600. That is a good income by almost any measure. The median household income in the United States runs about $75,000. You are doing meaningfully better than the average here. From a global perspective, you are in rarefied air. Now in Hawaii, that income feels different. The cost of living here compresses the real purchasing power significantly. $200,000 in Hawaii is not $200,000 in Ohio. So I'm not here to tell you that your income concerns are not real. What I am here to say is if you are a W-2 earner or a business owner in the 24% bracket, your biggest financial problem is probably not your tax rate. And building your entire financial strategy around reducing this year's tax bill may be solving the wrong problem at the expense of the right one. Before I get into the toolkit, I want to make sure something is clear because most people do not fully understand how the tax system works. The United States uses a progressive tax system. That means that you do not pay the top rate on your entire income. You pay the lowest rate on the first chunk, a slightly higher rate on the next chunk, and only your top rate at the dollars at the very top. Here's what that looks like in 2026. You pay 10% on roughly your first $11,900 of taxable income, 12% on income up to about $48,500, 22% up to about $103,000, and 24% on income from there up to roughly $197,300. For married filing jointly, those thresholds are approximately double. So if you are a married couple with $200,000 of taxable income, you are in the 24% bracket, but your effective federal tax rate is closer to 17%, not 24, 17. That gap between your marginal rate and your effective rate is often why the tax anxiety exceeds the tax liability. Now here's the bracket jump point that is worth paying attention to. The jump from 12% to 22% is 10 points. That is a significant jump. The jump from 22% to 24% is only 2 points, almost negligible. People will often panic when they jump from that 22 to 24% bracket, but that jump is almost nothing. But the jump from 24% to 32%, well, that jumps 8 points, and that's really where the real cliff is. So if you're at the top of the 24% bracket, the thing that's worth planning around is not reducing your tax bill. It's that you are not unnecessarily pushing income across and jumping into the 32% bracket. That is where thoughtful income timing and strategic Roth conversions actually earn their place. Now, the standard deduction piece. Before any income is taxed, you subtract the standard deduction. In 2026, that's $16,100 for single filers and $32,200 for married filing jointly. That is a meaningful chunk of income that is just not taxed at all. And because the standard deduction is now high enough, most people in the 24% bracket are not itemizing, which means the classic deductions like mortgage interest or charitable giving are not providing additional benefit beyond what the standard deduction already gives them. Now, Hawaii adds another layer. Hawaii's state standard deduction in 2026 is $8,000 for single filers and $16,000 for married filing jointly. Compare that to the federal $16,100 or $32,200. That gap means Hawaii residents have more state taxable income than federal taxable income, which is partially why the overall tax burden feels heavier here. The federal anxiety and the Hawaii reality are two different things. Understanding which one you are actually dealing with changes the conversation significantly. And if you stick with me to the end of this video, I'm going to share with you what I think is the single most powerful tax strategy at this income level. It requires zero complexity, zero illiquid assets, and zero professional fees to execute. Stay with me. But first, I want to walk you through 4 principles that will help you reframe how you think about every tax strategy you ever encounter. If you are a W-2 earner and you're not a business owner, your tax mitigation strategy or toolkit is fairly limited. Most people in this bracket are not itemizing, which means mortgage interest, charitable giving, and a lot of the classic deductions are not helping you beyond the standard deduction. Your real options are essentially this: maximize your 401k or your retirement account contributions, contribute to a Roth IRA if you're eligible, fund an HSA if you have a qualifying health plan, contribute to a 529 for education if applicable, do basic investment tax efficiency like tax loss harvesting, and think intentionally about income timing. Whether that is strategic Roth conversions in lower income years, timing capital gains realizations, or being intentional about when income hits so you stay on the right side of that 32% cliff. That is the list. Not a long list, but that's actually okay, because that list done consistently and correctly is genuinely powerful. The problem is not that the toolkit is limited. The problem is that when people look at that list and decide that it's not enough and start reaching for strategies that create more complexity, cost more money, and don't actually help them reach their real goals. If you are a business owner, the same core principle applies, but the toolkit is different and the leverage points are different. I will cover that in a dedicated video, but for now, everything that applies to you. Here's a principle worth understanding before you pursue any tax strategy. Saving on taxes often means spending more money than you are saving. Let me show you what I mean. Say you invest $100,000 into your business. You get to deduct that investment at, say, a 28% effective tax rate. You save roughly $28,000 in taxes. You are still out $100,000. That math only makes sense if the $100,000 investment helps you generate more revenue or income than you would have otherwise. If the investment stands on its own merits, then the tax benefit is a real bonus. But if the investment does not make sense without the tax benefit is not saving you money, it's helping you lose it more slowly. Let me give you a real example, the G-Wagon. If you own a business, you may have heard that some vehicles will qualify for immediate depreciation under Section 179. A G-Wagon hits that weight threshold, so you're able to write off the entire purchase in the year you bought it. So some business owners buy a G-Wagon or an equivalent vehicle and call it a tax play. But here's the honest math. A G-Wagon is a depreciating asset. It goes down in value. It has carrying costs, insurance, maintenance, registration. You saved your effective tax rate on an asset that is worth less every year and costs you money every year to own. Now, if you genuinely need a vehicle for your business and you love the G-Wagon, buy it, but do not call it a tax strategy. Call it what it is, a purchase that you wanted to make that also happens to have a tax benefit. Because humans are smart enough to convince themselves that almost any purchase is a smart financial decision. I hear it all the time. It gives me status. It helps me attract better clients. But the question worth asking is this: would I make this investment if the tax benefit wasn't attached? If the answer was no, that's your real answer. Here's another one worth naming clearly. Some tax strategies are genuinely good strategies. Donating appreciated stock to a charity is a real and meaningful tax move. You avoid capital gains on the appreciation, you get a deduction for the full fair market value. It's a legitimate strategy. But here's what it also means. You're taking that asset out of your net worth. You still own less. The tax benefit is real, but the asset is gone. Now, that is a good strategy if charitable giving is genuinely aligned with your values and your plan. It is a poor strategy if you are doing it solely for the deduction and not fully accounting for what you're giving up. Every tax strategy has a cost, and sometimes that cost is worth it, and sometimes it's not. The question is always, what am I actually trading? And if what I'm trading is serving my real goals. This is important. Most tax strategies do not eliminate your tax bill, they just defer it. A 1031 exchange lets you roll gains from one property to another without triggering a taxable event. That is a real benefit, but the tax does not just disappear, it waits. And the execution has to be perfect. I recently spoke with someone who was sitting on real estate interest worth 8 figures. They were weighing a 1031 exchange, and the strategy made sense on paper, but the execution complexity was staggering. Finding suitable replacement properties across multiple states in 180 days, coordinating with attorneys, CPAs, qualified intermediaries, all under a hard deadline. The strategy is only as good as your ability to execute it under pressure and under the clock. That is a risk that lives inside almost every complicated tax strategy. No strategy works without the right execution. Complexity is not sophistication. Being truly advanced in anything means keeping it simple, explainable, actionable, manageable. Strategy that you cannot execute cleanly is not a strategy, it is a liability. Let me tell you about the most important tax planning conversation I've had recently. Someone I was speaking with was looking at selling an older real estate holding. There was a meaningful gain on the sale, and they were looking at doing a 1031 exchange into a REIT to defer about $40,000 in taxes. On the surface, it made sense. $40,000 is real money. Why pay it if you don't have to? But when we slowed down and looked at the deeper why behind the move, something became clear. They did not need more income. They did not want more complexity in their financial life. They needed liquid, accessible funds for Roth conversions, or for travel, really for the retirement that they have been building towards. The REIT came with ongoing management fees, low liquidity, expensive transaction costs to exit, and money tied up they would actually need access to. Deferring $40,000 in taxes would have actually cost them significantly more in the wrong structure for their unique situation. We paid the taxes, they kept access to their money, funded the Roth conversions, built the retirement runway they needed, and simplified their financial life instead of adding complexity to it. That is what solving the real problem instead of the felt problem actually looks like. The tax tail was almost wagging the dog. $40,000 in savings or deferred taxes that would have cost them their freedom, flexibility, and peace. Here's something to consider if you are in the 24% tax bracket and genuinely looking for a powerful tax strategy. The 24% federal rate is historically moderate. The top federal rate has been as high as 90% in the mid-20th century. And remember, the jump from 24% to 32% is 8 points. If tax rates go up in the future, then locking in today's 24% rate on as much income as possible starts to look like a very good move. Which is why your Roth is arguably one of your most powerful tax strategies at this income level. Contribute now at 24%, let it grow completely tax-free, pull it out in retirement paying 0. You locked in a historically moderate rate with money that's going to compound for decades and never be taxed again. That is a better long-term outcome than most tax mitigation strategies at this income level. And it requires no complexity, no illiquid assets, no depreciation schedules, no tight timelines. Just a consistent contribution to the right account for a long time. Let me come back to the couple from the beginning of this video. They had no retirement timeline, no definition of financial independence, $1 million goal with no reason behind it, and they wanted to save on taxes this year instead of building towards freedom later. That is not a tax problem. That is a clarity problem wearing a tax planning problem costume. No amount of tax mitigation fixes a clarity problem. And so here's the truth that I want to leave you with. The goal of tax planning is not to pay as little tax as possible this year. The goal is to keep as much of your wealth as possible over your lifetime while building the life that you actually want. Sometimes those are the same thing, and often they are not. For most W-2 earners and business owners in the 24% bracket, the fundamentals done well will take you further than any mitigation strategy. Max their retirement accounts, fund the Roth, contribute to the HSA, build the 529 if education is a goal, do basic investment tax efficiency. Think intentionally about income timing, especially as you approach that 32% threshold. And if you are a business owner, invest in your people, your operations, your systems, the things that actually grow your business and your bottom line. Then redirect the energy that you are spending on tax anxiety to the questions that actually matter. When do I want to retire? What does financial independence actually look like for me? What do I want my money doing for my life? Those questions, answered clearly and honestly, will do more for your financial future than any tax planning strategy I can offer you. Now, for genuinely high income earners making 7 figures and above, tax planning gets more important and the tools get more meaningful. At that level, the disposable income exists to make more complicated and expensive tax strategies worth exploring. But that is a different conversation for a different video. If you are a W-2 earner or a business owner in the 24% bracket, stick with the fundamentals, they work. One more thing, the tax planning planning checklist that we put out is real and worth using. The fundamentals on that list are worth doing. This video is not to say that taxes don't matter. It's saying know what problem you are actually solving before you start optimizing. Because the most expensive financial mistake is not paying too much in taxes. It is making the wrong decisions because you're focused on the wrong problem. If you found this useful, hit subscribe. I keep on putting out practical, Hawaii-specific financial planning content, and I want to make sure you see it. And if you want to have a real conversation about your tax planning, your financial goals, and bringing everything together, this is the exact type of conversation that we welcome here at Claw Capital Partners. Head to clawcapitalpartners.com, schedule a discovery call, and I'll see you in the next one.